What if you could predict what would happen if you invested into an asset such as an apartment building? Let's say if you put in 50, 100,000 or more into a deal, and without a shadow of a doubt, you'd know how much it was going to make for you. Unfortunately, there's no way to completely predict something, as there's always going to be some element of uncertainty with anything that you invest in. I don't care what it is. But there is a way to take certain data and compile it into something, and that something is called a pro forma. This is basically a document that's putting together a best guess at how a particular investment is going to perform. In this video, we're going to go into detail about what exactly a pro forma is, why it's important, when it's used, what information it contains, and how you can use it in order to figure out if a deal is good or not. If you're new to this channel, hi, I'm Dr. Jeff Anzalone, a periodontist helping doctors and other professionals exit the rat race by building multiple streams of passive income. If you want to get started on how to do it, you can download the free passive income guide with the link below this video. When I first started learning about real estate investing, I wanted something that wasn't going to completely take me away from my family. Now, I don't know about you, but I deal with people, patients here in my dental office all day long, and I certainly didn't want to deal with any more when I get off work. Yes, I do want my tenants to pay the bills, but I didn't want to be involved in the day-to-day operations of running a property. Luckily, I stumbled onto something called a real estate syndication, and it actually allows people like you and me to pool our money together to buy something much larger than we'd be able to purchase on our own, such as an apartment building. Then what happens is the sponsor or the general partners, which is actually the group that manages the property, they're the ones that actually deal with the tenants and make sure that everything is operational each day. Once I decided that this is what I wanted to invest in, the next step was trying to figure out, once I started looking at these deals, whether the deal was good or not. And one of the first things to grasp when you first start investing is understanding how to determine a property's potential effective gross income. So basically, the amount of money that let's say it's an apartment building, how much money, what's the potential that if you were to invest your money in this building, what's the potential income that it can provide? Now, commercial real estate, such as apartment buildings, they're based on the amount of income it produces instead of what the others are selling for in the same market. For this reason, one of the most important parts of investing involves understanding how to determine the potential rental income. And probably you've guessed it, one of the ways to do this is by using the pro forma, which again is a report that gathers current or estimated income and expense data to actually project the net operating income and the monthly cash flow of a property. If you decide to look into investing in these syndication deals, such as I do, then you're going to need to have a basic understanding that will allow you to compare different investment properties and avoid making poor financial decisions. Now, let's get into why is a pro forma important to begin with. Now, it's crucial for you to, again, have a basic understanding about how to analyze one of these real estate pro formas. This is because the NOI, or the net operating income, and the cash flow projections from the real estate pro forma are also used in other calculations, such as the cap rate, the ROI, or the return on investment, and the cash on cash return. Once you have a general understanding of pro formas, you'll be able to identify those with actually inaccurate net operating income and inaccurate cash flow projections to help prevent you from making poor financial decisions. Now, what exactly is a real estate pro forma? Pro forma is a Latin term that actually means for the sake of form, or as a matter of form. And it's essentially basically just a forecast of a property's cash flow. It's a forecast of a property's cash flow and using its future potential income and expenses to show how actually a property could perform if certain adjustments were made, such as if you were to improve the property, if you were to expand the property, if the vacancy loss decreased, and then if you were to take the rents and increase them. Basically, what would happen to the cash flow? Again, it's a forecast. So When is a pro forma used? A pro forma is typically used when an investment property, like an apartment complex, basically it's when it's being sold. This projection is occasionally used to determine certain financial metrics, again, such as the cap rate, before it actually hits the market. It can also help prospective buyers figure out what the ROI is or what it would be if they decided to purchase it. You could also use it whenever a broker is selling the property. So if a commercial broker is selling a property, they'll typically perform an analysis and compare its performance to the market standards. This will help to determine areas where the income and or the expenses could be increased or lowered to create a pro forma. Now, after this cash flow projection is completed, it's basically listed based on the analysis obtained and the going cap rate for that particular commercial real estate type in the market. It's also used whenever a property is selling without a broker. Now, if this is the case, this is where it's important actually to either be able to create a pro forma or have one created for you to analyze. So you can either do it yourself or have somebody do it for you. It's the real estate investor's responsibility. So basically, it's your responsibility. It's my responsibility if we're buying a property without a broker to actually go in and verify that the property can actually perform according to the pro forma that's given to us. Occasionally the rental rates or the expenses actually the broker provides will actually be inflated or deflated to actually boost the property's projections. What exactly is contained in a pro forma? Remember, a pro forma is nothing more than an estimate, and just like any estimate, the longer it goes out to the future, what do you think happens? The less accurate it becomes. It kind of reminds me of my life. What I thought it would look like when I got out of dental school, when I had two young kids, has not gone the way that I thought it would. I guess that's just life. So, for example, when my kids were 6 and 4, I had a fairly good idea what I thought our life would look like 3 to 4 years later. But I had no idea that when they became teenagers, for whatever reason, I think aliens come down from UFOs, they kidnap them, and they replace them with some sort of moody robots that sleep, eat, and are cranky all the time. Now, if you have teens, then you know what I'm talking about. So let's get back to proformas. So regarding proformas, becoming less accurate the further it forecasts. Remember, so for example, if you were to look at it the first few years, maybe years 1, 2, and 3 of it, like a 10-year pro forma, it's going to be pretty, reasonably accurate, as they're based on the recent operating history. Now, on the other hand, as you go further out, say years 8, 9, and 10, it's less likely to be accurate because it's based on a series of assumptions. And some of these assumptions may or may not turn out to be true. Generally, the information in a pro forma can be broken down into 3 categories: the income, the operating expenses, and the debt service. And I've got, I was looking in my pile of papers, had one right here, and I'll show you what it looks like. This is one for a self-storage fund that I was looking at. So you can see income here, expenses, and it just kind of shows you year 1, and this goes out to year 5. So that's what it looks like. Again, it'll be given in the offering memorandum, and they'll email that to you as well. So let's get into the income first. Normally, there's actually 3 sources of information that can be used to estimate a property's income. You can have the historical performance, and they can actually use the historical operating statements to see how the property has performed in the last, let's say, 12 to 24 months. Also can get income from the rent roll, and that's nothing more than just a list of tenants and the current rent that they're responsible for paying. And then you look at the current market rental status. So basically, how property is being sold within the local market conditions. So basically, if this property, let's say, was in Chattanooga, Tennessee, it's going to look at what the corresponding buildings are selling for or renting for as well in that area. The second part that we showed in the pro forma is operating expenses. This is basically what it costs to run a property on a daily basis. And I'll just list out a few things here: taxes, utility, insurance, maintenance, advertising, property management fees, etc. And then the third thing is actually the debt service. And the debt service on a property is based on the loan amount, the interest rate, and the amortization period. Now, as you can imagine, it's much easier to project actually the debt service over a multi-year time horizon, especially if it's a fixed interest rate loan versus one that has a variable interest rate. Now, what are some of the metrics that can be calculated? Now, there's typically three key metrics that can be calculated from a pro forma, and that will help again measure the potential return for an investment property that you're looking at. The first one is the NOI, and that's the net operating income. It represents the amount of cash that a property produces basically just from daily operations. This is one of the most important metrics needed as it's calculated basically by deducting the expenses from the overall income. And when the income that I'm talking about is like the gross income. The gross income meaning income, not just the rents, but income coming in from all over the property. It could be cover parking, could be if you're charging for internet, cable, if you have laundry services on the property. So all of that income together would be the gross income. Uh, Subtract out the operational expenses, and that is going to give you the net operating income. Now, something else to consider is regarding the cap rate. And the cap rate is actually applied to the projected NOI in the final year of the holding period, and that will help to estimate the sales price. And the formula for the cap rate is this NOI, the net operating income, divided by the value of the building. So, for instance, if the net operating income is $40,000 on a particular property, and it's sold for $1,000,000. $40,000 divided by a million, so have a 4% cap rate. All right, the second metric that can be calculated is this internal rate of return, and it actually represents the annual return produced by the pro forma cash flows. It includes both the original purchase price and the sales price. And really, the formula to calculate these, it can be very difficult and complex. And so, for usually this reason, um, when you see these on websites and that sort of thing, you usually have to have some sort of spreadsheet function to determine it. And the third metric is the COC, the cash on cash return, and it actually refers to the return on capital that's actually invested in the rental property. It provides basically a number. It's usually expressed by a percentage. It actually represents the relationship between the cash that you invest and its cash flow. And it's calculated basically by dividing the cash investment divided by so basically it's the pre-tax cash flow by the original investment. And so, for instance, if the NOI is $12,000 and you originally put $50,000 in it, well, the 12,000 divided by 50, that gives you basically a 24% cash on cash return. The last thing we're going to talk about is what to look for in the fine print of the pro forma. Now, remember, the pro forma, as we stated, and I'll keep stating it, it's only an estimate. Okay, so during a transaction, it's not uncommon for a buyer to actually have their own version of a pro forma, and then the sellers have their own version of a pro forma. As you can imagine, differences can occur, which these differences typically occur within the fine print. Most of these pro formas, they give a set of assumptions in order to determine the property's performance that they think is going to happen in the future. And some of the most important ones are, as you can imagine, the income and the expenses. And most pro formas make assumptions that both the property's income and the property's expenses will slowly increase over time due to what? Due to inflation. Typically these assumptions shouldn't be more than 1.5 to 3% annually. Second is the occupancy. And as you're well aware, there's no property that's 100% occupied all the time. I don't care what people tell you. And it's for this reason that pro forma should make an assumption about the property's vacancy rate over the holding period. Typically, it should not be less than 5 to 7%, especially in a multifamily like an apartment complex. The third is the lease renewal rate. More than likely, the tenant leases will not last for the entire holding period. So, for instance, most of the syndications that I invest in have about a 5 to 6 year hold period. As you can imagine, leases don't go out that long, maybe 1 to 2 years. So assumptions should basically be made about the rate at which these leases they're going to renew, along with being consistent with the market rent based on the per square foot basis in the area. And the fourth is a capex, with a capital expenditure. Most of the syndication deals that I've invested in, they reside in this value, what's called a value add class, and this is where capital is used. Extra money is used to improve the property. This could mean you paint it. You could repair the walls, repair the light fixtures, countertops, any type of improvements. So this money goes to improvements. Now these funds basically, again, they must be accounted for in the pro forma, and they should result in overall an increase in rent, and they also should result in increased occupancy. So part of your due diligence process before you invest in real estate involves reviewing the sponsor's pro forma. And if you're looking through and some of the numbers you don't think add up, maybe some of the numbers are missing, or maybe appear too conservative, or on the other end too aggressive, simply ask for an explanation or maybe some additional information from the sponsor. And again, make sure that you read the fine print to determine if there's any key assumptions, or to determine if key assumptions are reasonable. It's supported by data in order to determine exactly how accurate the performance actually is. Now, if you want to learn more about my personal investment strategy I'm currently using for wealth building, and I talked a lot about real estate syndications, you can check out this video over here while I'll get into it in a little bit more detail. I'll see you over here.